Okay, so let's begin our today's session. A very good evening. Welcome back. This is Swati Gupta, Chartered Accountant. This is session number 2, wherein we started IS 16. In today's lecture, we'll complete IS 16. All right. We understood the IFRS, why it was introduced because of the Enron scandal, to improvise the disclosure requirements, to improvise the presentation. The IFRS came into picture. Then gradually, India also accepted it in multiple phases, and thereby now we have Indian accounting standard also, which is converged form of IFRS. All right. IAS 16, one of the major standards, we discussed that earlier we had fixed asset. If there was any long-term asset, non-current asset, we used to classify it as fixed asset. But after the introduction of IAS 16, IAS 40, thereby, firstly, every business has to look at the asset and look at and check its purpose. Okay, the intention behind the purchase. If it is for business purpose, if the use case is for business purpose, we will classify it as IAS 16, property, plant and equipment. But in case if the use cases otherwise, let's say to collect rent or to realize capital appreciation, or maybe a combination of both, then in that case we will classify it as investment property. All right, so we will quickly go ahead, revise a little that we read in lecture number 1, and then we'll go through the finishing of the IAS 16. Okay, is there anybody who did not attend first lecture but is attending today's lecture? Please raise hand. Hafiz, Funny, give me a quick thumbs up. Were you there? Did you attend first lecture? All right, all right. So it's not new for you, correct? Anybody who did not attend first lecture, who has not watched the recorded but is there today and is attending, because today's topic is in connection with first IAS 16 lecture. Attended? Okay, nice, super. We said that it's tangible asset used for business case, for collecting rental, main business activities to collect rentals, or for a head office purpose, admin purpose, we'll classify it as property, plant and equipment. When can accountant pass a journal entry? When the recognition criteria set by the specific standard is satisfied. So probable economic future and cost can be reliably measured. In that case, if both the conditions are satisfied, if both the criteria are satisfied, then we can pass a journal entry. What are the components? The price will be added. The trade discounts, the rebates received on the purchase will be deducted, but cash discount will be charged in P&L. It will not be adjusted from the cost of the asset. Any non-refundable taxes for which the company will get a separate input credit, those are recorded as separate current asset, and therefore the amounts are not again included in the cost of the property, plant and equipment. Import duties, till the time the question is silent, till the time nothing is said, we will assume it as non-refundable. We will assume all the taxes as non-refundable unless and until specified otherwise. Unless and until a question specifically says, a situation specifically says that this particular tax is refundable. All right. Apart from this, every time you will assume as if the taxes paid are non-refundable taxes. Okay, non-refundable tax, generally assume, general assumption. Okay, in case if the question is silent. Talking about IAS 23, we'll talk about IAS 23 in detail, but later. Right now, any interest expense that you're paying regarding that asset, and if it's a qualifying asset, you go ahead with the capitalization. Right now, let's leave it and we'll cover it under IAS 23. We'll read this IAS 23 after we complete IAS 16, property, plant and equipment, and IAS 40, that is investment property. Once we complete both these standards, then we will head towards borrowing cost, IAS 23. Any directly attributable cost which is really necessary to bring the asset in a situation which is ready for use. As soon as the asset is ready for use, you will go ahead and capitalize all the necessary costs. As soon as the asset is ready for use, after that, if there are any expenses, those are charged in P&L. Example, site restoration, initial delivery, handling costs, installation, assembly, professional fees, example, lawyer, engineer, any fees that we have paid, cost of testing, site restoration. These are some examples of the directly attributable cost. Trust me, there will be questions in exam wherein they'll give you multiple cost components and you have to identify which will be added to the cost of the asset. They will ask you, okay, what will be the carrying amount on this and this date of this and this asset? So if you know these components are allowed and these components are not allowed, easily you can calculate the carry mark. It would be a very easy question, scoring question. So we have to be very clear with each and every item. Costs not to be included, these are the costs that will always be charged in P&L. Let's say any inauguration expense, any new service, any new location expense, general overheads, admin overheads, any expenses which are incurred after the asset is brought to the location and condition. Okay, after the asset is ready for use. After that, any I would say expenses are done, that will not be capitalized. If the asset is idle, not being used or being used at half capacity, then we'll charge in P&L. Initial operating losses will be charged in P&L. Very importantly, relocation, staffing, training, retraining, these all expenses will form part in P&L. They will never be added to the cost of the asset. Why? Because the asset is ready for use irrespective of whether your staff is trained or not. Are we good till here? Anybody, any doubt in cost that will be added and cost that will not be added? Please raise hand for questions. Please unmute and be comfortable. You can ask question. I really love answering questions. So I would love to have questions from you, if any. Are we clear? Give me a quick thumbs up. Be just quick in the chat box. Write in the chat box clear. Afi says all right. Fani says all right. Vijay says thumbs up. Okay. Pavan, are we good? Good to go? Okay, nice. Good, good. All right. Next, we had an example regarding depreciation. We understood that is P&L and OCI. Why OCI? OCI is to protect P&L so that there are unnecessary notional changes. Those are not impacting the real profits. The user comes to know that, okay, these are the real profits, realizable profits approximately, whereas OCI items, those are the notional profits, those are done only for the accounting purpose. They are not the real ones. So in order to segregate notional and real gains, P&L and OCI is prepared. The reason behind OCI is to protect P&L, to record notional gains, and any expenses, any incomes, those are done in owner capacity. In equity capacity, those are recorded under OCI. Okay, examples are employee benefit expenses, IFRS 19, wherein you create defined benefit contribution and defined, there are two plans. Depending upon that plan, depending upon the planned asset, you create and charge through OCI. It is written under IS 19. So we'll look at it when we read IS 19. Right now, it's too early to understand any example related to equity. Okay. We read about revaluation. All right. So whenever there is a gain, you will charge under OCI. Whenever there is a loss, you will charge under P&L. Whenever there is a gain, you will charge under OCI. Whenever there is a loss, you will charge under P&L. All right. But subsequently, let's say again there is a loss. Then you will not straight away jump to P&L and charge the loss on fair valuation. Instead, you will check, was there any profits? Was there any gain in previous years regarding this asset? If yes, you will charge that to OCI. You will record that to reverse it from OCI. And then the remaining excess loss will be charged in P&L. On the other hand, if you have a gain in subsequent year, in next year, and following year, then in that case, again, you will not straight away jump and record the entire gain on fair valuation OCI. Instead, you are required to check, was there any loss on fair valuation in previous year regarding this asset? If yes, you'll reverse it off from P&L first, and then the remaining excess gain will be charged to OCI. All right, we had a very good example. Anybody, any doubt with this example? There was upward valuation. So we recorded a journal entry, asset was debited, increased, and a gain was recorded to OCI. Then afterwards, next year, there was a downward valuation, 950. So your asset was decreased by 950 and the losses were charged not directly to P&L entirely. Instead, the previous amounts was first reversed off. Earlier, it was credited to OCI. Now it is being debited to OCI. The remaining balance and figure was recorded into P&L. Anybody, any doubt in this journal entry? Tell me yes or no. Anybody, any doubt in this journal entry? Okay, give me a quick thumbs up. Are we good? Do you get this? Anybody, any revaluation surplus and revaluation reserve are one and the same? I would say approximately yes. Revaluation reserves and revaluation surplus are one and the same thing. All right, one and the same thing. You can say retained earnings, or I would say reserves and surplus. These are one and the same thing. All right. Just importantly, retained earnings, retained earnings and revaluation surplus or revaluation reserve, one and the same thing. These both items are balance sheet items. Give me a quick thumbs up. All right. These both items are balance sheet items. In your balance sheet, you will see equity. Under equity, you will come across equity share capital, share premium, retained earning, revaluation surplus. These all balances are balance sheet terminologies. These all items are balance sheet items. This simply refers to consolidated P&L. I would rather say, instead of consolidated, I would rather say cumulative P&L. This represents cumulative P&L till date. Let's say the company is running business from last 20 years. Obviously, in these 20 years, they would have earned some profits and had some losses. Cumulative amounts are reflected under retained earning. All right. Similarly, business is being run since last 20 years. All right. If an entity is running a business from last 20 years, they must have had some gain in the OCI or some expenses and losses in OCI. Then cumulative OCI balance is reflected under revaluation surplus. You can say P&L till date is cumulatively shown under retained earning. Cumulative OCI is shown under revaluation surplus. Hafiz, are we all good? Revaluation surplus and revaluation reserve are one and the same thing. All right, good, good, good. Okay. Next, let's go ahead with timing of revaluation. Before timing of revaluation, I want to discuss the transfer. All right, the transfer. I want to discuss this question which says about transfer. All right. Let's say, is there anybody in the class, in the session, who wants to buy a car and want to go on a world tour? Is there anybody who wants to buy a car and go on a world tour? Anybody? Please raise hand. Anybody? No? Okay. Okay. Hafiz says he wants to go on a world tour and buy a car. Let's say. All right. So equity shares, equity share capital, and share premium. All right. Let's take an example. Hafiz wants to buy a car, and thereby, being a very smart accountant, he has saved and made some reserve. Let's say rupees 2 lakh. Example, Hafiz wants to buy a car, and thereby, being a very smart accountant, being a very professional accountant, he has managed to make a reserve, a saving of 2 lakhs. Let's say Hafiz wants to go on a world tour. All right. And thereby he has saved another 1 lakh. Let's say rupees 1 lakh. And for emergency purpose or for other purpose or for, let's say, diploma and IFRS purpose. All right. He has saved again, let's say, just an example, 3 lakh. All right. Hafiz, are you married? Happily married? No. Okay. Let's say Hafi's girlfriend, okay, gives him a car. All right. Happy? Okay. Now you had a saving of 2 lakh. Now you have already received the car. You already have got a gift as car. What will you do of this reserve? What will you do of this money? Yes. Transfer to some other purpose, correct? Maybe World Tour, maybe other, or maybe you will make some other wish list, correct?
Yeah.
Okay, very simple. Do you agree if you receive anything as a gift or something, okay, and if you have a reserve, it does not become zero. You will not be like, oh my god, my 2 lakhs are wasted now. Make sense? The amounts that you have saved will be shifted, will be, I would say, diverted to some other purpose. But your savings are your savings, your reserves are your reserves, your profits are your profits, your savings are your savings. It does not become zero just because you have got something from outside. All right. Similarly, in very simple words, I would say a revaluation surplus is a specific reserve. Is a specific reserve. Example, car reserve, Volto reserve, other reserve. All right. So revaluation surplus is a specific reserve related to some particular asset. Whereas retained earnings, for understanding purpose, they are general reserves. They are general reserves. All right. Now let's take an example. You had a revaluation surplus of rupees 1 lakh for machinery X. Let's say you had a revaluation surplus of rupees 1 lakh for machinery X. If the company disposes, sells out this machinery X, do you agree the revaluation surplus related to this machine X does not make sense? Should also be derecognized? Tell me yes or no. I want each one of you to quickly answer, maybe in the chat box, maybe using a thumbs up. Do you agree that if you have a revaluation surplus for machine X, then if machine X does not exist, then the revaluation surplus related to this asset should also not exist. All right. So what do? We transfer revaluation surplus to retained earning. We transfer revaluation surplus to retained earning. The way we transferred our extra profits, extra reserves related to car, the car motive does not exist anymore. So we have diverted. Similarly, here also you divert. Now there are two ways of transferring revaluation surplus to retained earning. Now company has two ways, two choices to transfer revaluation surplus, okay, in retained earning. Two ways. Transfer revaluation surplus to retained earning. Okay, there are choice with the company, choice with entity. Entity has a choice whether to choose cost model or in revaluation model. Entity has a choice whether they want to transfer revaluation model and retained earning in either of the two methods. Both are the choices given. Option number 1, transfer over remaining useful life of asset. Transfer over remaining useful life of asset. Another option is transfer on date of disposal altogether. All right. They have two choices. Let's say the remaining useful life is of 5 years. So you will divide your retained earning, your revaluation surplus by 5 and transfer that 1/5 amount every year to retained earning. One way. Second way is do not pass any journal entry, do not transfer anything during the life of the asset. But on the date of disposal, whatever amount is standing in revaluation surplus related to that particular asset on disposal, please remove that, please transfer that to retained earning. Give me a quick thumbs up. Are we good till here? Do you get this? There are two options. Do you get this? Tell me yes or no. Tell me yes or no. Do you get this? Yes.
But for the first option, is it asset sold or it is still in our books?
It is still there. See, we are talking about the asset till it is there in the business. Once it is sold off, okay, then we are not talking about it. It does not exist anymore.
Okay.
All right.
Can I have a practical, like one example for first situation? Like
Definitely yes. 100% yes. Okay. I'm going ahead with the same. I'm talking about we will talk about the difference. Okay. Along with an example. Right now, just understand that company has to transfer revaluation surplus to retained earning related to any specific asset. Now, there are two options. Either on disposal date, they can transfer the entire revaluation surplus to retained earning, or they can transfer over remaining useful life. Let's try an example. Crinkle prepares its financial statement to 31st December each year. What is the financial year? 1st January to 31st December. All right. The financial year is from Jan to December. It bought an asset that had a useful life of 5 years for $10,000 in January 2006. In January 2006, they have made a purchase. Start of the year, they made a purchase of $10,000. No residual value is given and 5-year useful life. On 1st January 2008, whenever there are multiple dates and figures given, I want you to draw a timeline. I want you to draw a timeline as in what is the financial year, what is the date. Example, you'll say that on this timeline, we have a financial year from 1st Jan 2008, all right, 2008 to 31st December 2008. The machine was purchased on January 2006. 1st January or January 2006. That means how many years before? How many years before?
2 years.
2 years, correct? 2 years, 24 months before, correct? Pavan, Fani, Vijay, correct? Whenever there are multiple dates and figures given, every time you need to draw a timeline like this. Very importantly, the secret behind getting right answers is to pay attention to question, to deeply and carefully read the question. The more, I would say, carefully you read the question, it increases your chances of getting right answers, that too very easily. All right. The asset was revalued to 12,000 on 1st January 2008. Revalued at 12,000. Okay, 2 years later, it was revalued. It was purchased at $10,000. Now it has been revalued. The expected useful life has remained unchanged. It was total 5 years. Now also it is total 5 years. It is the policy of Crinkle. Crinkle has a choice and thereby they choose a policy. Crinkle company chooses a policy to make a reserve transfer for excess depreciation. They make a reserve transfer for excess depreciation, account for revaluation and treatment of depreciation in 2008. Okay, tell me, cost on 1st January 2006 equals to $10,000. What is depreciation? Depreciation for 2006, depreciation for 2007. Tell me the depreciation.
$2,000 each. 6,000.
2,000 each, correct? $2,000 and $2,000. This means WDV on 1st January 2008 equals to $6,000, correct?
Yeah.
On 1st January 2008, the revalued amount is given. What is the revalued amount?
12,000.
Correct. On 1st Jan 2008 equals to $12,000. Is there any gain or loss? Yes or no?
Yes, 6,000 each.
6,000, correct? $6,000 is your gain on fair valuation of property, plant and equipment. And do you agree it will be charged under, whenever there is a gain on first time revaluation, it will be charged under
OCA.
Revaluation.
it will be charged under revaluation surplus. It will be charged under OCI. Pawan, Fani, quickly answer. Gain on fair valuation of property, plant and equipment will be charged under other comprehensive income, which will be reflected under revaluation surplus balance in our balance sheet. Correct? Okay, we are good till here. Now, let's understand this. Cost revaluation. If you would have gone ahead with cost model, what would have been your depreciation? $10,000 divided by 5 years life. Correct? Divided by 5 years life, that is $2,000 depreciation per annum. Correct? After revaluation, what is the amount? 12,000. Correct? And remaining useful life equals to
3 years.
3 years. Very good. So what would be the depreciation in case of revaluation?
4,000.
$4,000. Can you identify excess depreciation?
2,000.
Correct. Very good. Excess depreciation equals to $2,000. Okay, give me a quick thumbs up. Pavan, Fani, Vijay, quickly confirm. Are we good? Hafiz, very good. Okay, nice. All right. Now let's understand our transfer fund. Now there are two ways. In our P&L statement, in our statement of P&L and OCI, statement of P&L and other comprehensive income, we have P&L and we have OCI. Okay, what will you do? If you are transferring revaluation surplus to retained earning over the remaining useful life, you will charge excess depreciation in OCI. So here the depreciation will be minus 2,000 and here the depreciation will be, or you can say excess depreciation, minus 2,000. In our balance sheet, we have equity. Under equity, we would be having retained earnings and revaluation surplus. Correct? Retained earning would have been of X amount and revaluation surplus would have been of 6,000. Correct? We had a revaluation surplus of 6,000. Tell me yes or no. We had a revaluation surplus of $6,000. Correct? Now, herein, you would have decreased excess depreciation. Your OCI balance has decreased. Do you agree? If OCI balance decreases, your revaluation surplus decreases? Tell me yes or no. Okay. If you are charging excess depreciation under OCI, your OCI balance will decrease and your revaluation surplus balance will decrease. This means it will decrease, it will become zero over the 3 years. All right. You are somewhere transferring, okay, transfer of revaluation surplus to retained earnings over useful life, over remaining useful life, over remaining useful life. Clear? Are we good till here? Any doubt? Please confirm. Any question? Clear? Very good. Okay. Hafiz, Vijay, yes.
Why should an entity will follow like this kind of reporting? Transfer
See,
part amount.
it's a choice with the company.
Yeah. For any other reporting reasons, is there?
For any other reporting reason. Again, see, I would say rather, do you agree if asset will give you benefit for, let's say, 5 years, you try to charge the expense to P&L over 5 years, correct? In the form of depreciation.
Yes.
Make sense? Similarly, you have a gain on fair valuation. This gain on fair valuation will be derived, I would say, realized, let's say, in next 3 years. So, you don't want to overburden your P&L in 1 year. Instead, what you are doing, you are charging this gain on revaluation. Since it will be received over 3 years, you are charging the entire amount to P&L over 3 years. Clear?
Got
Matching
it.
concept prevails.
Yeah, got
Make
it.
sense, Hafiz?
Excess profit
Hafiz?
there. Yeah.
Correct. So that there is no, I would say, any surprise. All right, surprise
Yeah,
element.
understand.
Okay, so that the financials are very comparable each year. Clear? Let's take otherwise. When the company does not go ahead with the transferring, then what will happen? Again, there is P&L and there is OCI. Okay, they will charge depreciation in P&L. Depreciation equals to minus 4,000. Nothing will be charged over here. In the balance sheet, again, you have equity. All right. Equity, we have retained earnings and we have revaluation surplus. In retained earning, minus 4,000 will be done. Profits decrease because of depreciation, your retained earnings decrease, and your revaluation surplus is of 6,000. There is no adjustment done. Now, on date of disposal, entire revaluation surplus balance will be transferred to retained earning. We will say revaluation surplus debit 6,000 to retained earnings 6,000. Clear? Over here, there will be no balance on disposal because over the 3 years, the revaluation surplus have been transferred to retained earning. Then after 3 years, the balance will be zero in revaluation surplus. No balance in revaluation surplus, therefore no entry on disposal date. Herein, there is no transfer over the remaining useful life. Thereby, on the date of disposal, you have to pass a journal entry wherein you are transferring entire revaluation balance related to that asset to retained earning on date of disposal. Give me a quick thumbs up. Tell me yes or no. Any question, please come up. All right, Hafiz, Vijay, good. Pavan, all right. Okay, nice. So, we have same question already said. 6,000 is your gain and this is how you charge your depreciation, excess depreciation. All right. Now we'll go ahead with the revaluation and its depreciation. There are three categories. I'll explain you how it works. Firstly, before going, we earlier also discussed book value equals to carrying amount are one and the same thing. All right. Book value and carrying amount are one and the same thing. These are the amount at which any item in books is recorded. Correct? Example, if an asset is recorded at $5,000, then $5,000 is the carrying amount, $5,000 is the book value, carrying amount. Okay, let's take an example. Revaluation or fair valuation, one and the same thing. Revaluation and depreciation. Revaluation and depreciation. Now, let's take an example that there was a book value of $100 and now there is a fair valuation of $120. Now, the most important dilemma is, as an accountant, do you charge depreciation on $100 or $120? All right. Whenever there is revaluation and you have to charge depreciation, a very important crucial question that arises that when to on what amount we should charge depreciation. Should it be book value or fair value? Should we charge depreciation on book value or should we charge depreciation on fair value? So there are three cases. There can be three cases where the revaluation is done at the start of the year, revaluation, fair valuation done at start of the year, at beginning of the year, mid-year revaluation or fair valuation, one and the same thing, or end of the year revaluation. Clear? Or you can say fair valuation, one and the same thing. There can be three cases, either fair value is done at the start of the year or end of the year or mid of the year. I'll give you an example. Let's say Jio wants to acquire Hotstar. Do you know about this Jio acquisition on Hotstar? Do you know Hero and Honda? Do you know Vodafone and Idea? Tell me yes or no. Do you know these are all mergers, acquisitions? Correct? Let's say Jio wants to acquire Hotstar or has recently acquired Hotstar, or whenever mergers and acquisition major deals are being carried on, do you agree these companies don't wait for 1st January or 31st December? Instead, whenever the deal is fine, the deal is closed, all right, they go ahead and merge and acquire. It can be mid-year any day. It can be any day of the year. They don't wait for start of the year or end of the year. They don't wait for 1st January or 31st December. Correct? It can be done any day or, during the year. So if it is fair value at the start of the year, then we will say revalue and then charge depreciation. Revalue and then charge depreciation. This means the depreciation will be charged on fair value. This means depreciation will be charged on 120. Give me a quick thumbs up. Whenever the fair value is done at the start of the year, you need to revalue first and then charge depreciation. Whenever it is at the end of the year, charge depreciation. Yes? Any doubt, please go ahead. Unmute and go ahead. Depreciation, charge depreciation on book value and then revalue the asset. Then fair value the asset. Then revalue the asset. All right. If it's mid-year, let's take an example. 1st May. Let's take an example. 1st May. During the year, then in this case, you need to calculate depreciation on pro rata basis. Okay, from Jan to 30th March, let's say your financial year is from Jan to December, for first 4 months and remaining 8 months. Okay, just an example, you will charge depreciation on value cost, that is $100, multiplied by whatever the years are. Okay, cost multiplied by months divided by total useful life. Herein, you will calculate depreciation on fair value multiplied by 8 months divided by, very important, remaining useful. Okay, quickly note it down. Very good. Quickly note it down. Please remember remaining useful life. Okay, we'll try a question, try to apply the same thing and see if we get right answer. All right. Revaluation and depreciation. Whenever there is fair valuation, there is a question. There can be confusion. Do you charge depreciation on opening figure or on the revalued amount? So if it is at the start of the year, we will charge depreciation on revalued amount. If it is at the end of the year, revaluation, then you will be charging depreciation on the book value. If it's mid-year, you will pro rata and calculate depreciation on cost for first initial months. And as soon as there has been a revaluation, you will charge depreciation on revalued amount for remaining useful life. Okay, let's try an example. Start of the year, mid-year, and end of the year. Let's try an example. Auckland company purchased a machine for 60,000 on 1st January 2007 and assigned a useful life of 15 years. On 31st March 2009, it was revalued to 64,000 with no change in useful life. Okay. What will be the depreciation charge in the relation to this machine in the financial statements of Auckland Company for the year ending 31st December 2009? Do you agree there are multiple dates and figures given? What do you need to draw? What do you need to draw to get right answer?
Timeline.
Timeline. Very good. Okay. A clear timeline will give you right answers. So go ahead, draw a timeline, mark your financial year. What is the financial year for which you need to do the entire solution? Draw a timeline and mark your financial year. What is the financial year?
Jan to December.
Correct. Jan to December. 1st January to December 2009. When it was purchased on 2007. How many years back? How many years?
3 years.
3 years. All right. Okay, so on your timeline, mark 1st January 2007, mark 1st January 2009, mark 31st December 2009. Now, what is the date of revaluation? Date of revaluation is 31st March 2009. Tell me, is it start of the year, mid-year, or end of the year?
Mid of the year.
Middle.
Middle of the year, correct? Middle of the year. How many months later after purchase, if you calculate from purchase date, how many months later this has been revalued?
2 years, 3 months.
2 years, 3 months.
2 years, 3 months, correct? 27 months. Pavan,
Yeah.
please confirm. Do you agree? 27 months afterwards, after 27 months, the Auckland company has revalued the asset. Correct? 27 months, very good. Okay. Now you need to calculate only the depreciation expense for current year. You need to calculate depreciation expense for year 2009. Correct? Your question is only and only depreciation expense that will be charged in P&L of 2009. It has nothing to do with WDV, revaluation, etc. All right. Therefore, we need to be very clear with what is the requirement of question. Do you agree your timeline looks like this? 1st January purchase at 60,000, 31st March it was revalued for 64,000. 2 years and 3 months later. For this 3 months, if it's a mid-year, you will calculate depreciation on cost, depreciation on cost, and here you will calculate depreciation on fair value. Here you will calculate over total useful life, whereas here you will calculate over remaining useful life. Okay, give me a quick thumbs up. Are we good till here? Please confirm. Are we good till here? Got it? Okay. May I get the answer? May I know what is the amount that you will charge in current year's P&L? Hafiz, Pavan, Vijay, I want you all to try and tell me what is the amount of depreciation that you'll charge in P&L. Will you remember over remaining useful life?
Up to 31st March 2009, we have to charge 9,000. That is first year 4,000, second year 4,000, and for the 3 months we have to charge 1,000 rupees. Sorry, $1,000.
Okay. And after 31st March? See, you have calculated right, the figures are right, but the answer is incorrect. Why? Because you need to tell the amount of depreciation in your current year. What is your current year? Your current year is from 1st Jan 2009 to 31st December 2009. All right. So you have to tell me the amount of depreciation that you'll charge in P&L in 2009.
Okay.
Got it? Please read it one more time. Let's go ahead. What will be the depreciation charge in relation to this machine in the financial statements of Auckland Company for the year ending 31st December 2009? It is not asking till date depreciation. It is not asking depreciation till the date of revaluation. Instead, it is asking what will be the amount that will be debited in P&L in 2009. All right. So you have to tell me the depreciation related to this 3 months plus this 9 months in 2009. Okay, Pavan, any answer? Vijay, any answer? Hafiz? Okay, let me tell you. Cost equals to $60,000. How many months? 3 months. How many total months? Total months equals to 15 years into 12 months. 180 months. Correct? Plus revalued amount, that is 64,000 into 9 months divided by remaining useful life. After 180 months, if 24 months and 3 months have lapsed, so 180 minus 27, that is 153 months. Please tell me the answer. This is your total useful life and this is your remaining useful life. Please give me a quick thumbs up. Do you get this? Depreciation in 2009 equals to $1,000. Very good. Plus physical calculators are allowed. You can easily use in your exam also. 64,000 into 9 divided by 153. This will give you approximately 3,765. All right, so depreciation will be 4,765 in the current year. All right, in the current year in 2009 in P&L. Anybody any doubt? Please confirm. Anybody any doubt? Do you want me to pause? Do you want me to wait? Any question?
Swati, if there
Yes.
will be any specific date, then we have to calculate as a days
In
or
number
it
of
will be in
days.
the
Yes,
month,
correct. In number of days. Yes.
number of days. Okay.
Okay, let's say it's a mid-year. Again, Geo will not think about which date it is. They will not wait for 1st or 30th. Instead, it can be any date. Let's say 8 August. All right. So in
Okay.
that case, what you have to do is calculate day-wise in the number of days.
Okay, fine.
Generally, for our exam purpose, months are proportionated generally. Okay. But in our practical life, there can be any day acquisitions and mergers and fair valuation. Thereby, you should know that we will go ahead with day-wise proportionment. Any other question? Okay, let's go ahead with another topic, which is depreciation of asset with 2 or more significant parts. Very small and simple topic, a common one. I'll give you an example. Let's say we have land and building. Let's say we have land and building. Okay, land attracts 0% depreciation, whereas building can attract 5%, 10%, 20% depreciation. Correct? Tell me yes or no. Land and building are together compound asset, complex asset, cannot be detached, but land has 0% depreciation and building has 10%. Okay, so these kinds of asset which has different rates, different useful life, different rate of depreciation and different useful life, those are known as complex asset, those are known as compound asset. Let's say if we talk about any aircraft, let's say if we talk about any ship, okay, spaceship, satellite, any huge machine, do you agree? Their parts can have some limited lifetime. Let's say if you talk about car might have a useful life of 10 years, but the engine might have a useful life of only 5 years. Let's say if we talk about AC, air conditioner, it might happen that the AC has 20 years of useful life, but the compressor might have only 3 years of life. Tell me yes or no. Let's say you have refrigerator. Do you agree? Your refrigerator can have a 15 years of life, but the compressor, the cooling agent, something out of it might have a limited life. Happens? In our geysers, it happens the rod has a limited life. Every second year you have to get it changed. Whereas the geyser, the asset might have multiple years of life. So whenever the components of asset attracts different rate of depreciation or different useful life, then in that case, those assets are known as compound asset, complex asset. Okay, in that case, how do you calculate depreciation? You have to calculate depreciation by splitting and then calculating. Just an example, let's say land is of 20 lakh rupees, whereas building is of, let's say, example, just an example, 30 lakh rupees. All right, together they are of 50 lakh rupees. How will you calculate depreciation? Split and record depreciation. Split and calculate depreciation. Okay, split and calculate depreciation. Balance sheet. Balance sheet will have, let's say, non-current asset. All right, non-current asset will have property, plant and equipment. Property, plant and equipment will have a value of, let's say, 50 lakhs. Now you will charge depreciation. 20 lakhs into 0% is 0. 30 lakhs into 10% is 3 lakh. You will deduct 3 lakh. And then your final net property, plant and equipment, net WDV will be written as 47 lakh. Please confirm. Make sense? All right. So whenever there are multiple components, you will split the amount and then calculate depreciation and then deduct it from the respective asset. The asset will not be split and recorded. Instead, it will be shown as one single line item. Let's take a very good example. Calculate separately when they have different rate of depreciation or different useful life. Whenever they have different rate or different useful life, these are known as complex asset. Let's take an example. Weatherby company purchased a machinery on 1st July 2007 for $500,000. It is being depreciated on SLM basis over its useful life of 10 years. Residual value is given 20,000. How do you calculate depreciation? Cost minus residual value divided by total useful life. Simple, basic, straight away depreciation. All good, no worries. On 1st January 2008, following a change in legislation. Change in legislation means change in law. There has been a new law. Okay. Weatherby company fitted a safety guard to the machine. They have fitted a safety guard because of the change in law, change in legislation. The safety guard cost 25,000 and had a useful life of 5 years. Machine has a useful life of 10 years. Safety guard has a useful life of 5 years. Do you agree? Different useful life. They will have some different amount of depreciation. Correct? Vijay, Pavan, Hafiz. Good, Pavan. Very good. Vijay, good. Hafiz, do you agree? Okay. Now you have to calculate what amount will be charged in P&L. Pay attention. What is the amount that you will charge in P&L? They are not asking what will be the WDV at the start of the year, at mid of the year, at end of the year. Okay. They are not asking what is the carrying amount, what is the revaluation amount. Okay. What is new carrying amount, old carrying amount, etc. Instead, they are only interested in knowing the depreciation related to current year. Their year is ending on 31st March 2008. Multiple dates, multiple rates, multiple amounts. Go ahead and draw a timeline. Mark your financial year. Very importantly, draw a timeline, mark your financial year. What is your financial year? It is
2008.
2008, starting from 2007. First
First
April
April 2007.
to 31st March 2008. All right. So you have marked it. Now see, is there any date falling under your financial year? During your financial year, is there any date falling?
Yes, 2 dates.
2 dates, correct? Even the
Oh,
machine is purchased mid-year and the safety guard is also installed mid-year, correct?
yes.
Okay. Can you mark those both dates during your timeline, on your timeline? Does your timeline look like this? This is your financial year. Very important to get right answers. You have to pay attention to the timelines to your financial year, and then only your answers will be right. All right. So your machine was purchased on 1st July. Your safety guard was purchased on 1st January 2008. This means 6 months. That is 9 months for asset, machine, and only 3 months for safety guard. 10-year life, whereas 5-year life. So split the components and then calculate depreciation. Can you try to calculate depreciation? I'm waiting for your answers. Try once, then we'll discuss. Okay, any answer? You just have
37,250.
37,250. Okay, I've got one answer, 37,250. Hafiz, Pawan, do you agree? Any other answer? Carrying amount multiplied by number of months divided by total useful life. Then carrying amount multiplied by months divided by total useful life. Hafiz, Pawan, are you trying? Okay. What's your answer? Nine months for machinery, 3 months for safety guard. Correct answer is 37,250. Good, Vijay. And how will you show this? You will not show your asset safety guard separately as a separate asset. Instead, it will be clubbed as single asset, complex asset. So 5,25,000 will be your asset value minus depreciation. That's how your WDV of asset will be shown on the closing date on your balance sheet date. Anybody, any doubt? Please confirm. Anybody, any doubt? Pawan, All good? See, just pay attention. Herein you had a residual value of 20,000, so it was deducted here itself. For safety guard, there was no residual value, therefore not deducted. All right. In case if there was any residual value given for safety guard, we would have deducted it over here itself. Okay, so that's how we have completed IAS 16. This is your homework question. Section B, wherein there are multiple questions asked. Now, in your exam, you are not expected to solve any multiple choice. You are not given any multiple choice. But right now, I've seen the kit, I've seen the past year paper, but there is no one specific one question which is specifically targeting only IS 16. There are questions which has IS 16, IS 40, IS 23 all together. All right. So right now I've picked some example questions so that you understand IS 16 and its application better. All right. This kind of question is not expected, but similar kind of question can be tested altogether. All right. Here there are multiple figures given, items given. You should know which will be added to the cost of the asset, which will not, which is allowed to be deducted from the cost of the asset and which will not. All right. Then there are 4 information given and there are 5 questions asked. I want you to answer all these 5 questions. All right. Very importantly, while answering this, there is one pointer that fair value is not available. The fair value of machinery is not available. The fair valuation is done after 4 years and the fair value of 4-year-old machine is not available. It can be possible that there is an old machine and there is no fair value available. So similarly, herein there was a 4-year-old machine. After that, they were doing revaluation and fair value was not available. Now, since fair value was not available, they have taken equivalent brand new machine, okay, to compare. Now, do you agree cost, or I would say carrying amount of 4-year-old machine cannot be compared with fair value of fair value of brand new machine? I'm restating, please confirm. Carrying amount of 4-year-old machine cannot be compared with fair value of brand new machine. Do you agree? Correct? Okay, you cannot compare apples with oranges. You cannot compare a brand new phone value with a 4-year-old phone value. All right, it does not make sense. You can compare a new phone with new phone or a 4-year-old phone with a 4-year-old phone. All right, but comparing a brand new with a 4-year-old asset does not make sense. The difference will not be the right difference. You will not be able to make a wise decision, informed decision. The conclusion will be incorrect. So therein, what you'll do, in order to make it comparable, you have to calculate fair value of 4-year-old machine. Then you will compare fair value and carrying amount. And then if there is any difference, the same will be treated as gain or loss in respective P&L and OCI. Okay, fine. So this 15,200 is not the value that you can directly take for a comparison. Instead, you will charge 4 years depreciation. Whatever amount comes will be your fair value of 4-year-old machine, carrying amount of 4-year-old machine, and then you will compare. This is the trick point, catch point that might confuse you. While reading it, keep this in mind. Give me a quick thumbs up. Will you try this question? It's your homework. Will you try this question? In the next session, whenever the next session is conducted, we'll go ahead and firstly discuss any doubt, all right, related to this, and then we'll go ahead with the next standard. Here, this is how we have completed our IAS 16. Every time once we end our lecture, I'll try to give 1 or 2 simple questions along with answers so that while you're revising, you understand its application-based questions also. All right. I think the concepts become very clear once you try 2-3 numericals around it. All right. We'll not wait for the entire syllabus and then start solving questions. Give me a quick thumbs up. Anybody, any doubt, please unmute and go ahead. Very good. Hafiz, Vijay, good. Pavan, all good? Any question?
Swati, how to present, see, like
How to?
our calculations and also like as you shown that
All
in
right.
the above example.
Correct. Okay. Now, there are two separate challenges. Firstly, to get right answers, and secondly, to present and score. All right. Two challenges. Correct. Getting right answers and then presenting and scoring. So, what is my agenda? We will firstly focus on getting right answers. Once we start getting right answers, once we start getting the concepts right, all right, then I'll tell you how to present your answer. It will be approximately this. Whatever I'm showing, it will be approximately this, but along with some extra explanation. Whatever we are speaking, whatever we are drawing, we need to explain along with it. Let's say why you have taken total useful life, why you have taken, why you have split and recorded. So you have to write in the explanation part that as per IAS 16, whenever there are complex assets which has different useful life and different rate of depreciation, thereby we need to split and separately calculate the depreciation. You will not have to learn the explanation part. If you know the concept, you can write in your language. Just use the terminologies that we are using while discussing. All right. You have to pay attention to the terms that we are using. You have to be clear with the terms that we are using. Trust me, it will be very easy to write your explanation and score. I'm not telling you the entire explanation and presentation part right now. Otherwise, facing 2-3 struggles altogether, it might mess up. Yeah. But ahead, once we go ahead, I'll tell you the explanation part also. No worries. Right now, just focus on getting right answers and presenting at least this way. The bare minimum, the basic one. Okay, this is the addition, this is the deletion. You know the correct answer, why it is flowing this way, what is the answer. Okay, just focus on this, be light. We'll take small steps and then reach our targets. All right. We have completed this, followed by, we'll start IAS 40. Give me just a second, I'll open my PDF. Okay, someone, I don't know, out of you or somebody in the other lecture asked to share this file before the lecture. I purposely don't share it before the lecture because what happens whenever we are discussing something, whenever we are solving questions, if you already have answer, okay, students try to look at the answers and go ahead of me. All right, they're not paying attention on the whatever is going on. So instead of doing 2-3 things and rushing ahead and going ahead of me, I want you to focus on whatever is going during the class. All right. And then afterwards, once we are done, I'll share the file right away and thereby you can refer, revise. If you have any questions, ask. All right. So thereby I don't feel like I don't have any, I would say, intentions to share it right before the classes. We are starting with IAS 40. Again, a very simple, basic, good standard. Okay. If you understand IAS 16, if you've got the understanding and basics of IAS 16 right, then trust me, IAS 40 would be a bonus for you. It won't seem like a trouble. IAS 40 investment property. Again, coming to a point, earlier we had fixed assets, or you can say long-term asset, non-current asset. All right. Earlier, we did not used to ask, okay, business, what is the purpose behind it? Instead, whenever an asset was acquired, we used to record it as fixed asset. But now, after the introduction of IFRS, after introduction of IFRS, we have to check the purpose of the asset. Okay, use in business or only to collect rent income and capital appreciation. Capital appreciation means the value increases. You have purchased something of 10 lakh and now it has become of 12 lakh or 50 lakh or 100 lakh. Okay, that's how. So only to collect the rent amount and capital appreciation. If it is being used for business purpose, we will say record as property, plant and equipment and apply IAS 16. If the entire idea is to collect rent and wait for capital appreciation, then you'll say record as investment property and apply IAS 40, IAS 16, IAS 40. Give me a quick thumbs up. Do you get this? You have to check what is the purpose behind the purchase of the asset, whether it will be used in business or whether it will be only held to collect rent and wait for capital appreciation. Okay, give me a quick thumbs up. Are we good? Yes.
In the second situation, it is and means rent and capital appreciation both needs to be there, right? Or if we have only
One
rent,
can also be there. One can also be there. You only have an intention to collect rent or capital appreciation or both are fine. All right.
if
Let
we
me
can-
make it
if
more
we
clear.
take it as for rent only, then it will be treated as like commercial and it will come under business.
No, dear. Let's say, just an example, you are running a business, all right, and you have a textile business, or let's say a shoe business. Now you have an extra storage capacity. Let's say you had an extra land, or maybe you want to start a new factory, but not today, 1 year later or 2 year later. So during this 1 year or 2 year period, you have given it for rent. Let's say you had an extra warehouse. You will be using it when the demand rises, your production rises. But right now for a year, you have no intention. So what you have done, you have given your warehouse space for rental purpose. Now your entire business activity, your main business activity is to manufacture clothes, textile, shoes. Your main business activity is not to collect rent. All right. But simultaneously, there is some surplus and you're collecting rent out of it. All right. That rent will be considered as, that rental property will be considered as investment property because it is being not used in business.
Okay.
Okay. All right.
Yeah.
Okay. Coming to another part. I don't remember, but you have discussed or not. Let's say if we have, let's say Vijay Travels, and we have Vijay Travels, which runs a business of tours and travel. Let's say Vijay has 10 Volvo buses and 20 Innova cars. Now Vijay Travels' main business activity is to put these vehicles on rent and collect rent from the same. Make sense?
Yeah.
All right. Vijay, all right? Are we good? Okay. So thereby, if Vijay Travels earns rent, then it is their main business activity. This is their main revenue. All right. These 10 Volvo buses and 20 Innova cars will be treated as property, plant and equipment because they are held for business purpose and the main business activity is to collect rent. All right. If main business activity is to collect rent, the same assets will be classified as property, plant and equipment.
Okay. Before classification, we need to know their business model. Like
Perfect. Perfect. We have to check whether what is the use behind it. And in case if the use is not yet decided, let's say you have purchased something, now you're clueless about it, whether you want to start another shop, another factory, or whether you just want to put it on rent. You are not very sure. Then again, that property will be classified as investment property. If the use case is not clear, it will be treated as investment property. Till the time it is specifically being used for business purpose, it will be treated as investment property.
okay, understood.
All right, sure. In your balance sheet, in your statement of financial position, there will be non-current asset, long-term asset. All right. Under non-current asset, you will have two separate heads: property, plant and equipment, and investment property. These both items will be shown as separate line items. You cannot club and show the figures together. You cannot club both the figures and items together and show it as one single line item. Instead, you have to show property, plant and equipment and investment property as separate line items on the face of the balance sheet. Give me a quick thumbs up. Pavan, Hafiz, Vijay, give me a quick thumbs up. All right, nice. Okay, good, good. Super. Recognition criteria is very similar, but before that, let's read the definition. Property, it can be a land or a building or a part of building. We can also deal for any shop, any one flat out of the entire building. So it can be entire land and building or maybe a part of it. Let's leave the ROU asset right now. We'll read about it when we discuss IFRS 16. To earn rentals, the entire intention is to earn rental or capital appreciation or both. It should not be for production and supply of goods and services. That means it should not be a property, plant and equipment. It should not be inventory. Correct? It should not be inventory. It should not be property, plant and equipment. Then only you can classify any long-term asset as investment property. Next, owner-occupied property. Owner-occupied property is related to consolidation. Right now, time being, I'll give you a glimpse of it, just an idea. We will discuss the same while we read consolidation in detail. Let's say there is a parent company, an acquirer company, purchaser company, investor company, the company which has actually acquired control over subsidiary. Let's say there is a parent company, there is a subsidiary company, and they have acquired control over subsidiary. Now, parent had a land and building or a machinery, okay, extra, and said that, okay, do not worry, subsidiary, I give you, okay, give asset for use. And maybe in return, the subsidiary is providing, maybe in return, subsidiary is also providing rentals. Okay, paying rents, maybe. Now, parent is known as reporting entity. Parent is known as reporting entity. The entity which has to prepare financials is known as reporting entity. The date on which the financials are prepared are known as reporting date. Now, parent has to prepare two documents. Separate financial statements, standalone financial statements, individual financial statements, one and the same thing, and consolidated financial statement. All right, give me a quick thumbs up. Parent is known as reporting entity and they are required to prepare their SFS, separate financial statements, standalone financial statements, and consolidated financial statement. Now, if parent has given something, okay, to use, and in return they are collecting rents, do you agree parent will record it as investment property? Tell me yes or no. Correct? Record as investment property because they are collecting rent from the same. Parent is collecting rent from the same, and therefore it should be recorded as investment property. Now, during consolidation, there is an ideology, there is an assumption taken that parent and subsidiary are both one single group, are part of one family itself. All right, if one has given something to another, if they are buying and selling, if they are having intra-group profits, does not make sense. They are considered as one family member. If one sibling has given something to another sibling, do you agree as a family there is no increase in wealth or decrease in wealth? If one sibling has given something to another sibling, do you agree as a family there is neither an inflow nor an outflow? As a family, there is no increase or decrease in wealth, correct? Similarly, when we go ahead with consolidation, there is a family concept, there is a group concept, and we say that parent and subsidiary are one and the same single entity. This means, in a broader sense, do you agree the asset is being used for business purpose? Do you agree the asset is being used for business purpose? Using asset, correct? In business. All right. So in a broader sense, if you look at the asset, so from family's perspective, from group's perspective, the subsidiary is using the asset in business and thereby in CFS record as property, plant and equipment because it is being used in business from group's perspective. Okay. Later, when we read consolidation in detail, you'll come to know, okay, what is group, how the group works, how this entire accounting will be done. When we'll read these, then you'll come to know better. But right now, just for time being, you can understand. In standalone financial statement, parent is earning rental and thereby they need to classify it as investment property. In CFS, the entire machine is being used for business purpose and therefore it should be classified as property, plant and equipment. Give me a quick thumbs up. Are we good? Any doubt? Okay, nice. Is there anybody doing consolidation? Is there anybody doing consolidation? Understood? Good, Pawan, very good. No, all right. Hafiz, Vijay, did not come across consolidation? No, okay, nice. Vijay,
No,
any chances?
I have did it.
Sorry,
already.
you have done it, correct?
Yes.
So I think whoever is actually working with consolidation or has ever worked will relate with these concepts, correct? More relatable.
Yes, correct.
Sure. Okay. Let's go ahead. So owner occupied property held by the owner in production and goods and services or admin purposes. All right. Fair value. Wait a second before reading fair value. Please read this. Read the third point once. Okay. Makes same sense. In SFS, they will record it as investment property. In CFS, they will record it as same. Correct. All right. Next, if land held for long-term capital appreciation rather than short-term sale, okay, long-term capital appreciation recorded as property, plant and investment property. If building is owned by reporting entity and is given on lease, it should be recorded as investment property because they are collecting only rents. Property that is being constructed or under development for future use, recorded as investment property. Recognition criteria is exactly same. It is probable that future economic benefits will be there and the cost can be reliably measured. If both the criteria are satisfied, then you can go ahead with passing a journal entry and recognizing the asset in the books of account. Now moving from cost model to fair value is allowed. From cost model to fair value is allowed. But moving back from fair value model to cost model is not allowed. You are given a choice. If you want, you can go ahead with fair value. But once you have gone with fair value, you cannot come back to cost model. All right. Next, let's say a company has 5 buildings. And let's say building number A is recorded at fair value. Now it's company's obligation to record all other 4 buildings, all other 4 investment property at fair value. they have to apply same model for all the investment property. If company has 8 investment property, 80 investment property, they have to follow cost model for all 80 or fair value model for all 80 companies. They cannot go for like, okay, one investment property is at cost and another investment property is at fair value. They cannot apply this. Companies are prohibited to do the same. One investment property is classified at fair value. The other one should be also classified at fair value. Clear? They have to apply same model, same approach for all the investment property there with the entity. Give me a quick thumbs up. Are we good with the notes? Do you get this? All right, nice. Now we had a fair value definition. What is fair value? Firstly, fair value is given under IFRS 13. IFRS 13 tells you how to calculate fair value. IFRS 13 will tell you how to measure fair value. IFRS 13 will not tell you when to calculate fair value, for which assets to calculate fair value. When to fair value? It is given under respective standard. Let's say property, plant and equipment says that let's calculate fair value. Okay, then you will come and approach IFRS 13 and say that I need fair value calculation. Please do it for me. All right, give me a quick thumbs up again. Please confirm, do you get this? IFRS 13 will only tell you how to calculate fair value, how to measure fair value. It will not guide you when to fair value, for which assets to fair value. How to calculate fair value is given under IFRS 13. When to fair value will be given in respective standards. Respective IFRS will tell you when to fair value. All right, what is fair value? Fair value is the exit price, final price that you will get when you sell any asset, and the final price that you will pay when you transfer any liability, when you settle any liability. This is the exit price concept. Exit price concept. Okay, this is an exit price concept. How to fair value? This is the price that you will receive when you dispose any asset, when you sell any asset. This is the price that will be an outflow from your pocket when you settle any liability. In orderly transaction means where buyers and sellers are willing to enter into the transaction, they have negotiation power. All right, I'll give you an example. Let's say Pawan has a piece of land and property. All right, let's say Pawan has a piece of land and property. Suddenly, one fine day, government wants to build a national highway and says that, Pawan, we want to extend the national highway and thereby we want to acquire this piece of land and building, whatever it is. Don't worry, Pawan, we will give you a compensation of rupees 10 lakh. All right. Does it happen? Does these kinds of scenarios happen wherein there is a piece of land and building and thereby they compulsory acquire, the government can compulsorily acquire? Does it happen? They give the compensation. All right, does it happen? Have you ever heard about it? Pawan, Vijay? Okay. No, not. This is a case of compulsory acquisition, wherein the government has to acquire the same. Now, in this situation, do you agree, Mr. Pawan, the seller, did not have a choice? Give me a quick thumbs up. If government is compulsorily acquiring, giving a notice and setting a compensation, do you agree? Pawan, the seller does not have a choice, does not have an option, does not have negotiation power. Maybe he cannot bargain, he cannot negotiate. No, I don't want 10 lakh, instead I want 15 lakh. No, it cannot be negotiated. All right. This compulsory acquisition is not an orderly transaction. This is not a regular transaction. Why? Because buyer and seller are both not willing, are not having negotiation power. Both should be willing to enter into the transaction. Both should have negotiation power. compulsory acquisition made by the government is not an orderly transaction, and thereby 10 lakh rupees paid to seller, 10 lakh rupees paid to Pawan is not a fair value. You cannot take 10 lakh rupees as the fair value of that asset, of that land and building. All right, give me a quick thumbs up. Does it make sense? What is orderly transaction? Orderly transaction is without pressure, without influence, without biasness, where buyers and sellers are willing to enter into the transaction. They have negotiation powers. So government compulsory acquisition is not an orderly transaction. Any compensation paid during this transaction cannot be referred as fair value. Next, between market participants means unrelated parties. Do you agree? Whenever there are related parties, there can be chances wherein the fair values are not charged. There are some biased figures, some over or under figures are given. Maybe the transaction is not at arm's length price. So market participant means unrelated parties. Good. At measurement date means the date on which the fair value is calculated is known as measurement date. So what is fair value? Fair value is given under IFRS 13. IFRS 13 tells you how to calculate fair value. This is exit price that you get on selling an asset or that you pay on settling any liability in a normal regular transaction without any influence, where buyers and sellers are willing to enter into the transaction, where they have negotiation power. Between unrelated parties, the buyers and sellers are not related parties, and on measurement date, it is not a value of 10 years back. It's the most updated and relevant value on the date of transaction. So this definition, the calculation will be done in IFRS 13 when we'll read in detail. Right now, multiple times we are indicating and highlighting fair value. So herein there is a definition. You can learn this definition and include it while writing your answers. Okay, recognize. Initially, you will always recognize at cost. Very good. You don't have a choice. As an entity, you don't have a choice. Initially, you always have to record it at cost, but subsequently you get a choice whether you want to record it at cost model or fair value model. Under cost model, charge depreciation in a regular way and check for impairments. We'll read impairment afterwards. Under cost model, you'll charge regular depreciation. Very important, super important. Whenever you are recording investment property at fair value, you will stop charging depreciation. Whenever you are recording investment property at fair value, you will stop charging depreciation, and either it's a gain or a loss on fair valuation, it will always be charged on P&L. Okay, read this entire chart again. Try to learn it. Initially, always at cost. Subsequently, it's a choice. Cost model, charge depreciation, fair value, no depreciation, gain or loss, always in P&L.
What should be the reason for this one with not charging the depreciation for fair value?
Okay, I'll give you the reason. Fair value is the most updated value. All right, fair value already considers all the appreciations and all the depreciations. I'll give you an example. Let's say you purchased a mobile phone. Okay, let's say of rupees 1 lakh. Do you agree? As soon as you unboxed it, the value will go down.
Yeah.
Correct. You will not be able to resell it at 1 lakh. Instead, at a little lesser amount, maybe rupees, let's say 95,000. As soon as you have used it for, let's say 1 year, do you agree you will not be able to sell it at 95, instead maybe only 75, maybe?
Yeah.
Correct? And so on. These are example of fair value. The fair value already includes the upward and downward adjustments. It already includes the depreciation that has taken place. Yeah, because of unboxing, because of usage. All right. Okay. Secondly, the investment properties are appreciating nature, are of appreciating nature. All right. So therefore, we don't charge depreciation once we record the investment property at fair value. We are expecting that as soon as the property prices will boom, the real estate prices will boom. You'll go ahead, sell and realize the profits. Yeah.
Okay. Okay.
Okay. It has an appreciating nature. Secondly, the fair value reflects all the ups and downs. All the appreciations and depreciations are already taken care, are already reflected in fair value. Yeah?
Okay. Okay. Understood.
Good. Next, another question that I'm expecting is, why do we charge gain under IAS 16 in OCI but not gain under IAS 40 in OCI? Correct? Why are we charging gain in P&L? Is this your question? Do you agree?
Yeah, it is a realizable one, I think.
No, whenever we are selling it, then only we will use the IAS 40, right? So investment
Whenever
property
we
actually.
are not talking, no, dear, we are not talking about selling right now. Okay, we are not talking about the actual transactions right now. All right, this
Okay.
entire fair valuation is done on every reporting date. Whenever you're preparing your financials, all right, therein you have assets and you have to revalue the assets and calculate the asset and then record it. All right, we are talking about the asset valuation in the financial statements that you're creating on the reporting date. We are not talking about actual sale. Clear?
Okay.
Whenever we are making actual sale, there is no assumption required because you get an inflow, you have a WDV, and that's how the difference is there. Clear? Correct?
Yeah.
Yes.
When we are not disposing, it's there in the company and you revalue and there are differences. How do you cater? We are saying that if there is any gain or loss on fair valuation, you will always charge to P&L. I'll give you the reason why it is so.
It can be realizable within that time.
Sorry, go ahead. Can we
can be-
realize?
It can be realizable at that time if we can sell that asset to the market.
Okay, I'll tell you the reason behind this is the intention. All right. The intention behind IS 40, the intention behind investment property is capital appreciation. As soon as the company comes across and says that, okay, there is a gain, there is a likelihood of gain, they might take a step and go ahead with the realization. They might sell and try to gain that. All right, let's say you have a property of 10 lakh. Suddenly you come to know that it has become a 50 lakh. You might try to sell it and gain the profits. All right, the intention is to realize the appreciation. Give me a quick thumbs up. All right. These are very close to real gains. These are not real gains yet, but these are very close to real gains. Very similar to, let's say you have purchased equity shares on stock market. Do you agree? You have an intention as soon as it's profitable, I will sell it and earn profits. Maybe you have not earned it till date, but you have an intention to realize the gains as soon as possible. So the intention is to earn profit. So the gains which are being there on calculation are approximately the real gains. They can be actual any time. On the other hand, if you talk about property, plant and equipment, let's say you have a machinery of 10 lakh rupees. You are using it in business for production purpose. Now suddenly, if you come to know that the prices of the machine has increased, let's say to 50 lakh, do you agree you will not go and rush and sell? Instead, you will still continue to use in business? Please confirm. Do you agree? If the prices of machine has gone up, correct? Okay, do you agree, guys? Pawan, Hafiz, do you agree? The intention is to use in business and earn benefits, not to sell and earn benefits. All right. So thereby, whatever the gains are happening, those are completely notional. We have no intention to realize them ever. We have no intention to dispose of in near future. So thereby, whatever gains are happening on fair valuation, since there is no intention to realize, let's not disturb our P&L with unnecessary notional gains. Instead, charge to OCI. These gains are very similar to actual, they are about to happen. Thereby, we'll charge in P&L. Make sense? All right.
Yeah, if we shares get lended to some other person, if we receive any interest on that one, nowadays it is getting most
Okay,
famous.
you have landed shares.
Yeah, equity shares in the market, like we have shares in
Alright.
our demat account, we will give to some other person for rental purpose. So we will get some amount like interest or
Again, it's investment property. You had some investment, all right?
yeah,
You have
yeah,
given and then you're collecting some rent, dividend, interest, fees, something in that form. All
yeah.
right?
Then it will be come under the P&L part, right? Like gain or loss on fair value
Correct.
of.
The gain or loss will come under P&L part. Yes. But it is not your investment property. Rather, it is financial instrument. Rather, it is financial asset. All right?
Yeah, yeah,
All right. That is financial asset. Investment property is more of a physical asset. Whereas if you're talking about equity shares, equity instrument, debt instrument, let's say you have bonds of government, 6% bonds, 7% debentures, maybe. All right.
yeah, yeah.
All right. Those are also your asset, but those come under financial instrument, IFRS 9.
Okay, okay.
Under IFRS 9, we'll understand how to deal with financial asset, how to record the incomes, gain and losses, when in P&L and when in OCI.
Okay.
Okay. All good?
Yeah, yeah. Please correct me if I'm wrong. Like for the rental income in the P&L, we are trying to cater a separate line item in the balance sheet as investment properties, right? Is that the way how this
You
investment
can
property?
say that. You can say that. Investment property is firstly to segregate that, okay, this is something as a surplus in business. If you sell this, your business will still run.
Yeah, yeah, understood.
Got it?
Got
Okay.
it.
To segregate. So so the user comes to know that, okay, we have some surplus asset. Okay. In case if something goes wrong, we can sell this surplus asset and pay it off and still continue to survive. All right. One intention.
Yeah,
There is some surplus money, they can open new branch. Okay, they can earn extra income. So segregate what is being used in business, on which the business is dependent wholly, and on what part there is some excess amount given. All right, to segregate
yeah,
firstly.
understood. Yeah,
Okay. Secondly, again, if there is any interest income, dividend income, you can easily bifurcate and come to know that, okay, there is investment income and this is the portion of income that you're earning from these kinds of investment. Okay.
yeah,
So yes,
yeah,
extra income, extra asset, extra income, extra backup.
yeah,
As an accountant, we always want backups and provisions, correct?
yeah,
We cannot
exactly.
live without that. Do you agree, you guys also? Because I do it very much, very much. It has come into my blood. We create so much provisions for each and everything. Do you guys do?
Yeah, exactly. We will do.
Correct? Okay. I see people around me, like engineers and all. They like they don't they don't know about provisions, and I'm like, how can you live without provision? How can you not like how can you not assess something in few, like what will happen in next 1 month or 3 months or 6 months, and how can you not create a reserve for the same? I don't think we can operate as an accountant, correct?
Yeah,
So
exactly.
as soon as we expect any expense or losses coming up in our personal life also, we try to create a provision for the same. Okay. So again, same thing. As soon as you come to know that there will be a loss, you're creating a provision somewhere. Okay. As soon as you come to know that your investment properties will go down, you are charging the loss to P&L. In some way, you are recording a provision in P&L that, okay, expected losses, let's charge it to the current year. One more concept. Let's say there are multiple years. Okay. Let's say year 1, year 2, year 3. Let's say during the year, your investment was of 1 lakh rupees, and now it has become of 1,50,000. And let's say it has become of, let's say, 2,70,000. Just an example. Now, in the year 3, you are making an actual sale. If you don't record the gains in the respective years, all right, do you agree you will record a gain 2,70,000 minus 1 lakh, that is 1,70,000 gain in year 3 itself. Nothing will be recorded in year 1, nothing will be recorded in year 2, and year 3 you will have a sudden income of 1,70,000. Do you agree your financials will not be comparable? It would be a sudden rise in P&L. All right. So in order to make sure that we follow matching concept, period concept, all right. So any income related to this period should be recorded under this period. Any income related to this period should be recorded under this period. Any income related to this period should be recorded under this period. All right. So the entire thing says that record income, okay, earned in respective period. All right. And thereby, if you check this, if there is a gain, we are not waiting for final sale. Instead, we are booking it in that respective P&L. Every year, whatever the gain is there, whatever the gains which are not actual gains, still those are closer to actual, you are realizing in P&L so that your P&L is not over hyped, over, I would say, recorded in any of 1 year. All right. Clear? Any question? Good, good, good. Let's take an example, a quick one. If the purpose is not decided, how do you record? IS 16 or IS 40?
40.
Yes, 40.
Correct. Okay. So this can be a part of your question. A bigger question that if there is an asset for which the purpose is not yet decided, you will record it as IS 40. Okay, simple one. Let's try another example. 1 pointer, actually 2 pointers. Unless and until an entity specifically tells you that, okay, please follow fair value method. Okay. Till that time, you will follow cost model. Till the time the entity says you, please follow fair value method, then only you will go ahead with fair value method. Otherwise, you will always stick to cost model. Clear? Fair value model has to be exclusively stated for the companies. Next, second pointer. You will come across many terminologies in terms or in, I would say, in reference to years. Let's say 20W8, 20X8, 20Y8, 20Z8. Just an example. This W, X, Y, and Z represent a decade difference, a 10-year difference. They present a 10-year difference, 10-year difference. Example, if you are reading 20W9 as 2008, then 2000X8 will be 2018, 2000Y8 will be 2028, and 2000Z8 will be 2038. Give me a quick thumbs up. Do you get this? That this W, X, Y, and Z represent 10-year difference, a decade difference. Give me a quick thumbs up. And thereby, in case if you are reading 20W8 and 20X8, this means they are giving you the difference of 10 years. All right. Specifically in our ACCA exams, they will not give you 2008 and 2018. Instead, they refer WXYZ, PQR, ABC, okay, as in the year term, and thereby you need to read it in this manner. Let's refer a question. On 1st October 2000X9, Propex has the following properties. They have 2 properties. It uses fair value method for investment property. This means in case if there is any other property, they are not using fair value for all other property. They are only using fair value for investment property. It is completely allowed by IFRS that one entity can record investment property at cost and property, plant and equipment at fair value, or vice versa. See, it is allowed that a company can record one property, plant and equipment at cost and another investment property at fair value, or vice versa. It is allowed. They can choose one model for one class of asset and model for another class of asset. It is allowed. But for investment property, if one investment property is recorded at fair value, then all other investment property should also be recorded at fair value. Give me a quick thumbs up. Does it make sense? Different classes can have different model, but investment property, all investment property have to follow same model. All right. Tenant house, which cost 150,000 on 1st October 2004, the property is freehold and rented to private individuals. If a property is freehold, no purpose decided, rented to private individuals, is it investment property or property, plant and equipment? Is it IS 40 or IS 16?
40 IS 40.
40.
Correct. Everybody, do you agree? This is investment property because the intention is only to collect rent, not using in business. Very good. Investment property, fair value or cost model?
Fair value it is mentioned.
Fair value. Because question has exclusively said that investment property should be classified at fair value. The current fair value of property is 175. Okay, one more question. If investment property is recorded at fair value, do you charge depreciation? Yes
No.
or no?
No.
No.
No. Vijay says no, Hafi says no. Pawan, do you charge depreciation on fair value investment property? All right, very good, super. No depreciation, correct? This means, do you agree if the question asks you what will be the WDV, what will be the carrying amount? It would be 175 straight away, correct? Correct,
Yeah.
Hafiz?
Yes.
Make
Yeah.
sense? All right, super. Next. Question is asking you carrying amount. So carrying amount will be 175 for tenant house, which is your investment property. Next, stove place which costs $75,000. This is used by Propex as its headquarters. If any company is using any asset as headquarters,
PPE it is.
ISO PPE, correct?
Yeah, 60.
All right. PPE at what price? Cost or fair value? At what model? Good, Pawan. Pawan, cost, very good. Nice. At cost. Why? Because company has not exclusively said we will follow fair value. If company does not say exclusively, we will follow cost model till then. The building was acquired on 1st October 2000 W9. Now they want value at 2000 X9. Do you agree 10 years later? It was purchased 10 years before. Everybody, Hafiz, Pawan, Vijay, good?
Yeah.
All right, it was purchased 10 years back. The current fair value is 120. Do you agree? Okay, tell me yes or no. Current fair value of property, plant and equipment, is it relevant or not? Is this fair value for property, plant and equipment relevant or not?
Not relevant. It
Not
is
relevant because we have to follow cost model. Thereby, the fair value is irrelevant. Correct? It is just given for confusion purpose. They are saying they depreciate at 2% per annum. So let's calculate depreciation for next 10 years, thereby get a WDV of the asset, okay, at 1st October 2009. Example 20W9 and 20X9. I'm just referring for your future reference. 209 and 2090. 10-year difference. Okay. So what will be the value? 75,000 minus 10 years of depreciation. 75,000 into 2% into 10. Depreciation equals to depreciation for entire 10 years because you want carrying amount. So opening minus till date depreciation will give you carrying amount. Depreciation equals to
15,000.
15,000. So 75 minus 15 will give you 60,000. Anybody any doubt? Please confirm. Anybody any doubt? This is at fair value and this is at cost model. All right. This is how you need to explain your answer. Yes. Yes, Vijay, please go ahead.
When we have to, when the fair value is irrelevant.
When the fair value is irrelevant, because the Propex company policy is to calculate and record property, plant and equipment as at cost model. All right.
Okay.
They have a policy to record property, plant and equipment at cost model. If you're following cost model, then the fair value amounts given at that particular date is not relevant for your calculation.
Okay.
Make sense? Okay. Irrelevant for cost model. Irrelevant for cost model. Okay. Since we are following cost model, therefore it is irrelevant. 120 will not be considered. Okay.
Okay. Fine.
Sure. Sure. Next is deferred consideration. Whatever you purchase and if you would have paid upfront, this is known as cash price. Let's say you purchased a car of $100,000. Now you borrowed a loan and thereby paying interest on the same. And if you talk about the outflow, instead of $100,000, it is $130,000. You're paying 30,000 interest on the same. Now the question is, do you record asset at $100,000 or do you record asset at $130,000? So the answer is you will record asset at cash price. You will record asset at $100,000. All right, you will record asset at cash price. You will record asset at $100,000. Give me a quick thumbs up. The interest amount, whatever you're paying, will be recorded in P&L as expense. Okay, the reason behind this is as soon as the asset is ready for use, do you agree as soon as you purchase a car and it is out of showroom, it's ready to drive, it is ready for use? Tell me yes or no. As soon as the car is out of showroom, it is ready to use. After the asset is ready for use, any expenses incurred will be charged to P&L. All right, make sense? Yes?
Yeah, that means the interest we charged by the car loan, it will become under P&L. Right?
P&L, yes, 100% correct. Okay? Correct. Okay, next. There can be change in use. Maybe a company has an investment property and now they feel like, let's open another branch, let's open another factory, production unit. Maybe they have a production unit and they close down and say that let's keep it on rent. Vice versa case. There can be possibility wherein there is an investment property with the company and they are shifting the use case to business purpose, or vice versa, there can be a business property and now they are shifting towards investment property. Give me a quick thumbs up. Change in use case, change in purpose can happen. Pavan, Vijay, good, Vijay, Hafiz. Pavan, do you agree? Can happen? Can the use case change? Use case change during the life of the asset? All right. Let's say the use case has changed. This means now you have to shift from, let's say in this case, you have to shift from property, plant and equipment to investment property. You have to reclassify, or maybe from investment property, you need to reclassify to property, plant and equipment. You need to reclassify to investment property. reclassification. Give me a quick thumbs up. This is a case of reclassification wherein the use case has changed. Reclassification when use is changed. All right. When the use case has changed, there it requires reclassification. Now the reclassification will require a figure. How to decide the figure? Okay. We'll take the general scenario. Change in use of asset. Okay. Till the time there is a change in use of asset, apply previous standard. Previous IFRS standard. As soon as after change, apply previous IFRS standard till date of change in use. After date of change in use, start applying new IFRS standard. All right, I'll give you an example. Let's say earlier if it was property, plant and equipment, and now it has become investment property, till the date of change in use, you will apply IAS 16. After date of change in use, you will apply IAS 40. Give me a quick thumbs up. Do you get this? Till the date of change in use, you will apply previous standard. And after date of change in use, you will apply new standard. Clear? Okay. How will you calculate the difference? Fair value of asset on date of change in use. You will remove, or I would say deduct, carrying amount of asset on date of change in use. If fair value is more, it will be a gain. If fair value is less, it will be a loss. Give me a quick thumbs up. You will calculate fair value on the date of change in use. You will calculate carrying amount on the date of change in use. Whatever the difference is, if it's a positive difference, you will record it as gain on fair valuation on change in use. If it's a loss, if it's a negative figure, it will be treated as loss. Now, very important, record as per previous standard. Previous IFRS standard. All right, let's say there was a change from property, plant and equipment to investment property. Then as per previous standard, if it's a gain, it will be charged to OCI. If it's a loss, it will be charged to P&L. So this loss and gain will be charged to P&L and OCI respectively as per IAS 16, as per property, plant and equipment. Are we clear? Please confirm. All right, please pay attention. Let's say, 1 second. Okay, we'll calculate fair value. We will calculate carrying amount. Whatever the differences will be recorded as per previous standard. As per previous standard. So if it's a gain, it will be charged under OCI. If it's a loss, it will be charged under P&L. Vice versa case. If it is investment property, you will calculate fair value, carrying amount on the date of change in use. Whatever the difference is, it will be recorded as per previous standard, as per IAS 40. So either it's a gain or a loss, it will always be charged under P&L. Give me a quick thumbs up. Do you get this? Are you ready for an example? There can be change in use during the life of the asset. If there is change in use, till the date of change in use, you will apply previous standard. You'll calculate fair value, compare with carrying amount, whatever the gain on loss is, it will be recorded as per previous standard. Let's try an example. This is the last example for today, and then we'll close the session. All right. Everybody ready for example? Nice. Okay, good, super. Let's try. Multiple dates, rates coming up. Be ready for drawing a timeline. Capital owns a building which it has been using as a head office. Capital owns a company, owns a building, owns an asset and using for head office. If somebody is using any asset for head office purpose, is it IS 16 or IS 40? Is it property, plant and equipment?
16 it is.
Okay. Pavan, if you are using something for admin purpose, back office purpose, do you remember? Okay, it is property, plant and equipment because it is being used in business. All right. Okay. Now, in order to reduce the cost, on 30th June 2009, it moved its head office function to one of its production center and is now letting out head office. Now they have clubbed their production function and headquarters together. They've got a vacated building. This vacated building is let out, is put on rent. They are now collecting rentals. They are not running business in this building. Collecting only rent. Then it should be recorded as
40 investment property.
investment property. Correct? Pavan, are we good? Earlier they were using in business. Very good. All right. Earlier they were using in business. So we classified it as property, plant and equipment. Now during the year, they have changed and they have now let it out. They are not using it for business. So investment property. Company has a choice. Company can use either cost model or fair value model. So company uses fair value model for investment property. This means at fair value. My question, will you charge depreciation on investment property after 30th June? Yes or no?
No.
Okay. Vijay, correct? Pavan, good. Vijay, do you agree? That after once the investment property is recorded at fair value, we will not charge depreciation henceforth after 30th June. Okay. The building had an original cost of 250,000 on 1st January 2000. It was being depreciated over 50 years. At 30th June 2009, its fair value was 350 and at 31st December 2009, its fair value had fallen to 320. All right. Okay. What is your financial year? Draw your financial year.
Jan to December.
Jan to December, correct? Our financial year is from 1st January 2009 to 31st December 2009. Correct? This is our financial year. All right. Now, during this year, 30th June 2009, there is change in use. Correct? Change in use of asset, change in use of building. All right. It was purchased at what date? It was purchased at what date?
1st January.
1st
January
January 2000. All right. It was purchased on 1st January 2000. Okay. Please tell me the revaluation has, so the change in use has taken place how many months or how many years later? How many years later? From 2000 to 2009.
9 years.
Calculate. 9 years. Okay.
9 years,
Any other
6.
figure? 9 years, 6 months. Pavan? How many years? 9.6. Instead of 9.6, you will say 9 years and 9.5 either. All right, or 9 years and 6 months later. Correct? And then we have 6 months till the end of the year. There is a mid-year change in use. All right. 9 years and 6 months is written as 9.5 years. All right. So we are good till here. Now, on date of change in use. On date of change in use, what you need to do? You need to calculate fair value of asset. You need to calculate carrying amount of asset. And whatever the difference is, will be recorded as gain or loss. Fair value of asset on 30th June 2009 equals to fair value of asset on 30th June 2009 equals to, please read.
3,50,000 it is.
3,50,000. $350,000, correct? $350,000 is the fair value on 30th June 2009. 350. All right. We have carrying amount. Carrying amount of asset equals to cost equals to 2,50,000. $250,000 minus depreciation for 9.5 years. Depreciation equals to $250,000 multiplied by 9.5 years divided by how many years? Total useful life. Total useful life equals to 50 years. Correct? Can you calculate depreciation and divide minus it from 250 and tell me the carrying amount of asset? This is the cost. This is till date depreciation. Cost minus till date depreciation will give you carrying amount. 9 years and 6 months equals to 9.5 years.
Yeah. 2,02,500.
2,02,500. All right. You'll deduct it. Correct. If fair value is higher, it's a gain. Gain on fair valuation. Correct.
Yeah.
What difference is 147,500? All
Yes.
right. Gain will be charged as per
Previous.
previous.
16.
There
Yes.
is previous standard means IS.
16. Yes.
Correct. So it will be
OCI.
charged under OCI. Good. OCI as per IAS 16. Anybody any doubt? Please confirm. Anybody any doubt?
When we are classifying from PPA to investment property, we need to check that whatever the method they are following, like cost or WDV. Is that
Cost
make
or
any?
WDV. Correct. Correct. Okay. It can be the reducing balance method, SLM. Depends. But generally, in these kinds of questions, they go ahead with SLM. They don't want to, I would say, complicate things. They don't want to challenge, do you know WDV or SLM? They just
Yeah.
want to tell you, okay, they just want to test you. Do you know how to compare and tackle it in P&L and OCI? All right?
In real world, it will be based on the company policy, right?
100% yes.
Okay. From investment property to PP is also based on the company policy.
100% yes. Okay, but you need to follow the same thing: fair value minus carrying amount. Now, carrying amount can be calculated depending upon the policy of the company.
Okay. Okay. Thank you.
Okay, now sure. We have investment property. Here we had property, plant and equipment. Here we have investment property at fair value. and therefore it will have no depreciation. This is known as reporting date. All right. So on reporting date, what will happen? At reporting date, that is 31st December 2009, fair value of asset. Please tell me fair value of asset on 31st December 2009.
3,20,000.
3,20,000, correct? This is your new carrying amount. New carrying amount, correct? Minus carrying amount. What is your carrying amount of asset? Carrying amount of asset equals to
3,50,000.
3,00,000.
correct, 3,50,000. Very good. If fair value is lower than carrying amount, is it a profit or a loss?
Loss it is. So we move this to P&L or
Correct. We'll use it in P&L. In P&L as per IAS
40.
correct? That is 30,000. Loss. Anybody any doubt? Please confirm. Anybody any doubt? So during the year, in case if a question says how the same will be presented in your statement and statement of P&L and OCI ending 31st December 2009. So what you'll show, your OCI will increase by 147,500. Your P&L will decrease by 30,000. Give me a quick thumbs up. Your OCI will increase by 147,500 and your P&L will decrease by 30,000. Okay, so this is how you'll represent. This was the last topic in our IAS 16 and IAS 40. All right, so this is how we have completed the entire thing. The same timelines and all things have been drawn for your reference, so that this is all for your quick revision. When at the end of our syllabus, when you'll be you will be having multiple revisions, thereby these solved answers will help you. You don't have to look here and there. Instead, everything is there in your notes itself, so you can quickly revise. The more handy your notes are, I think it increases your speed, and thereby you will have multiple revisions, and thereby it will increase your confidence on the topics. All right, so the entire solutions are there then and there. For upcoming topics also, I'll try to include all the examples here itself. So for future reference, it will be easier. Clear? This notes, whiteboard notes, I do make them for clear understanding. All right. It's completely your choice if you want to note it or not. All right. Or if you want to simultaneously note it in your notebooks, it's completely your choice. All right. Apart from this, mostly 90% of the things are already there in the PPT itself. Okay. So this is how we have completed. Anything you want to go ahead with? How was the lecture? Any input? All right. Good. You had fun? Is it good? Nice. Okay. Yes, please go ahead.
Yeah, it is good. Everything
good.
is.
Okay, nice. Okay, Pawan, any input? Hafiz, any input? No? All good?
All good from my
Okay,
side.
okay. Nice. Okay. I'll try to keep the sessions this way interactive, so that if there are any doubts, you can get it resolved then and there. All right. I'll try to include some simpler examples in this manner, so that we end our IFRS with a complete clarity. All right. That's all from my end. Thank you so much for joining.
Thank you.
See you in the next session.
Thank you.
Okay, sure. Okay, bye. Good night. Thank you.
Good night.
Bye.
Bye.